So, hi everyone. Here I am with the man, the legend himself, Mr. Jim Schultz, the Michael Jordan of options trader. I would say that, man. How you doing today, my friend?
Man, I'm good. I appreciate you. I'm certainly no Michael Jordan, but man, I appreciate you very much. And yeah, I mean, what a time to be an active trader in the markets right now, right? I mean, it's moving around so much. I mean, the Nasdaq, Bitcoin. I mean, there's so many things going on. NVIDIA, right? SMCR, and MicroStrategy with Michael Saylor. Just so many things happening right now. It's a really exciting time to be a part of it.
Yeah. And the volatility went up a little bit, at least here in Brazil. It went up a little bit, man. And US too, man. I mean, those Nasdaqs and those big techs, they went up a lot, man. What do you think is going to happen in the next, I don't know, man, maybe in 2024, in this year? You think this thing's gonna still going up?
Yeah, I think, I would be surprised if we don't see some bumpy times ahead, like this year. I really would be, especially now. I mean, we just had the PPI data that came out this morning that also is showing that inflation is kind of reaccelerating a little bit. And so it's going to be very interesting to hear what Powell has to say and what his language looks like and sounds like around, rate cuts, higher for longer. Are we really done with rate hikes? I mean, it seems like we are, but man, if he even hints at the possibility that they may have to go up again, there is no way the market's going to like that. But again, I mean, I've felt that way for the last 12 months, and the market's been incredibly strong and incredibly resilient. I would just think, just from a natural market ebb and flow standpoint, not only from an inflationary standpoint, but from just natural market ebb and flow, I would be very surprised if we don't see some kind of pullback, 5%, 8%, 10%, whatever. That would be very healthy for the market long term. This is not sustainable. Like, I know it feels like, man, I need to buy. I think I missed the move. I got FOMO. I got all these things. That's how we always feel when it's kind of, euphoric optimism like what we have right now. I'd be surprised if the VIX stays under 20 all year. I think we're going to see the VIX over 20, 25, 30 at some point in 2024.
Yeah. Me too. I share that vision, man, and I'm hoping that happens. Man. Some I don't want to say a crash, but market went down a little bit, volatility goes higher, and we're looking forward for that, right? And so, guys, here let's talk about the thing that Jim is an expert here. There, options trading and options management. I know you guys are looking forward to see that. I'm going to show some trades here, Jim. I want to hear your opinion. Those trades we send to our subscribers on the trade alert, and some trades I've been doing with the viewers. And I'm not showing the good ones, man. The ones we closed with a profit. Here's some troubles here for you to help us to think. Share your experience on that. So I'm just gonna start sharing here. I did some nice slides here for us to see. Let me just put it on right here. And,
no, that sounds good. I mean, no, I don't want to look at the winners. The winners take care of themselves. The winners are not difficult. Those are not hard. I want to see the trouble. Let's look at the problems. Yeah.
Exactly. You're seeing the screen here?
Yes, I am. Yep.
So this actually is, I want to hear your opinion on some earnings trades, right? This was the earning trade we did on EL. I don't know if you're familiar with that company, EL. So
no, I'm not actually.
I'm sure your wife is, because this tell other companies, they are a big company on makeup business, women's accessories and stuff. But they have some brands like MAC, Sephora. They're very big, actually.
Mm-hmm.
So this was done a day before the earnings. So you see 7 DTE.
Mm-hmm.
It's a 7DT. IV rank was 98. I did this triangle outside the expected move, selling the 117 put and the 150 call. Stock was trading at 134. I got 243. So I didn't. There was the closest expiration, 7DT. They don't have weekly options. There was a monthly. So you used to do this kind of trade. Why are you doing earnings? You like doing strangle? You like going naked on earnings? Is that something you like? Is that something you approve?
Yeah, definitely. I mean, you just have to be, yeah, absolutely. I mean, I think earnings give you a nice opportunity to, boost your occurrences and get some short premium working for you. And a classic strategy is a short strangle. The thing you always have to be aware of when you're going into an earnings announcement is the possibility for like a mega oversized outlier move is much higher. And so because when the report comes out and all that new information hits the market, man, if the market, really likes what they hear or they don't like what they hear in a significant way, that can really send the stock a lot higher or a lot lower. Like even with a super wide strangle, you're outside the expected move, it feels pretty safe. That can change in a hurry. So when it comes to earnings, I definitely like to use all the same strategies that I would use for a normal cycle. You just have to be very, very aware of your size. And so, if you're doing, and it's not even about 1 lots, 2 lots, 3 lots, that doesn't even matter. It's about buying power. It's about buying power reduction. And so it's very important to keep your undefined risk trades to, man, I wouldn't go above 7% of my account in, net liquidating value. I wouldn't use more than 7% in buying power per trade for an undefined risk position going into earnings. So that means if you have, $100,000 US dollars, that would be $7,000 in buying power per trade. If you have $50,000, then it would be, $3,500 per trade. And of course, you can go smaller than that. That's not a problem either. But in terms of an upper limit, that would be my absolute upper limit.
Yeah, perfect. I mean, that's something people always make mistakes, right? They go too big on this kind of trades in one position specific. And when things go wrong, well, you're in trouble.
Mm-hmm. Yeah, no, you can get in trouble very quickly. And I could say, if I think about all of my big mistakes, I've been trading, since I started actively trading in 2007. So it's about 17 years. I would say that because we can all remember our really big mistakes, right? We've all made them. You've made them. I've made them. Everybody's made them. Yeah. Every single one of them, every single one can all be traced back to the same common denominator. I was too big in size. Yeah. I just always ended up putting myself in a position where I didn't have any wiggle room. I didn't have any options at my disposal. I was way too big. I was way too oversized. And that, did not allow me to proceed objectively with the position. And so that's why I always come back to size when it comes to things like this, because it's just so, so, so important.
Yes. Yeah, we've been seeing this for many, many years. Every time people have trouble, it all comes down to size being too big on the trade. So here's the earning estimates versus actual by quarter on EL. And in EL, you see the range of estimates was really big here. So I say even if this we have a big move, like I don't know, maybe 10% on the stock, and that's actually what happened. This trade is still going to be profitable. So we have a big range. So it was actually a good earnings. The stocks went up a lot, but we ended up closing buying back for $1 with 3 DTs, 3 days to expiration. So that's what happened on this trade specifically. Another earnings trade we have here is Hood. Here I'm seeing was reading here in Portuguese. I have to read it to write it in Portuguese because our viewers are here from Brazil. But I have write it here. There are many analysts that cover this stock, right? a lot of banks and assets, a lot of people look at hood. And when this happens, a lot of companies, a lot of banks making projections, it tends to go inside the expected range. You know, that when they release the results, the stocks don't go up too high or don't go down too high. And that's what happened with Hood. Hood was trading 11.55, another strangle on the 9.5 and 14. Just receiving just 28 cents for this one.
Okay. Can you bring that one up on the screen? I still see EL.
Oh, yeah? Oh. Let me see here.
Oh, there we go. Yeah. No, I see it now. Yeah. So you bought back EL for $1. And then you've got, okay. So
bought back for $1.
So that trade with that was not so.
You didn't see that? You didn't see that slide?
No, I didn't. But I heard you talking through it. And so that's fine. So the EL trade, that was an easy trade. You told me these were going to be hard trades. You told me these were going to be trouble trades. That was easy. You made a bunch of money.
I was wanted to hear your opinion on those earnings trades, man. I don't know how you do it. So we've been really successful.
I mean, I want to talk about Hood here in a second, but I'll just say this, that I think might be helpful for people out there. If people are having a hard time finding consistency with their trading, or they're newer and kind of just starting out with trading, I would not put a lot of earnings trades on, because again, you're walking into those potentially very, very chaotic stock price movements. I would focus on indexes to kind of get your feet wet if you're brand new, or to smooth things out if you've been trading for a while and your results have not been as consistent as you would like. Now, that's going to mean you're not going to be trading as much as you were before, but I think your results overall are going to be much, much, much better. Earnings have a time and a place, and I think they can bring a lot of opportunity, but they can also require, a significant amount of skill and, understanding in terms of what you want to do and how you want to manage. So if you're not quite there yet, that's okay. Like, it's not a competition. It's not a race. And so I would just slow things down, and I would focus on indexes. So I wanted to make sure I mentioned that to all of your traders that are kind of following along.
Yeah, no, that makes perfect sense, man. You have to have some awareness to do this kind of trades, right? So
that's right.
Yeah, I know there are many analysts covering Hood, so I think it was a safe bet to place on Hood. Now, Hood, for you guys that don't know, that's Robinhood. Is a broker, right? It's a stock broker in the US, very popular actually. So there was the trade receiving 28 cents right here. I think I'm gonna have to do this and change the slides here. We closed with 2 DTE for 9 cents. On those earnings trades, you think it's better to trade the closest expiration?
Not necessarily. I mean, it depends, right? Like, if you trade a very near-term expiration, then you're going to get paid off really quickly if you're right, and it could potentially hurt a lot more if you're wrong. And so it sort of depends on what type of risk and return that you want. If you choose like something further out, like 45 days to go, a little bit closer to like a normal entry point, then everything is going to be a little bit smoother. And so, it depends on the strategy. Like, if I'm doing something like a strangle, or I'm doing something like a vertical spread, then I would usually choose something that's further out in time, because I think the results are a bit more consistent. But if I'm using a strategy that is very well suited for the final week, like a butterfly, for example, then I will choose like that week or just a couple days to go.
Yeah, that's what I thought. The butterflies, they really pay off on the expiration week, right?
That's right. That's exactly right.
Yeah. So that's another earnings trade here. Cisco, we did with 2 DT, and that's really close with the money. We did it because Cisco is always reporting results that are in line with analyst estimates. So this one, we did a little closer at the money strangle. I did a 2DT and closed in actually the next day was the next 2 days. I left it expire out of the money because it was just almost at expiration. This Cisco trade right here. Well, yeah, there it is. So this one right here,
man! Wow, that Cisco trade. I mean, you got basically everything out of that. That's great. Wow. I mean, you bought that back for nothing. Yeah.
Yeah. The thing on earnings trades, if I have to leave some tips here for the viewers, is always choose very liquid stocks. There are a lot of companies are covering, a lot of analysts are making projections because the average is going to be pretty close to what really happened. So that's one tip I would give to the guys. And don't go to the those stocks that don't have much liquidity. Not many firms are looking at it because the chances you're gonna have a big move on the stock are higher, in my opinion.
Mm-hmm. Yeah, no, I think that's a pretty good tip. I absolutely agree with that. I mean, when you're doing like a Cisco, I mean, Cisco has been around forever. I mean, Cisco is like, yeah, I mean, that's a pretty stable company. And so I think doing strategies like strangles and things like that would probably be more successful and more consistent with companies like that. Yeah, I agree.
Yeah. And Cisco has been reporting in line with the estimates for the last 6 quarters. So that's another thing that increases your odds, right? Because they are reporting in line. So you expect it for them to report in line with estimates again.
Mm-hmm. Yeah, no, that's a great point. That's a really good point. So what do you have here? What is MCHI?
This is the ETF for China. This is the Chinese ETF. There's a lot, I don't know, maybe 200 Chinese, the 200 most biggest Chinese companies. I don't know if you used to trade that. We did a strangle here. The stock was trading at 37. IV rank was really high because Chinese economy went at some rough times in 2023. And this ETF went all the way down from 45 to 37, something like that. And we did this strangle, getting 83 cents, an ETF with 53 days to go. And then I want to show you is this right here. This one at 21 DTE right here. Stock was trading at 39.90. Remember, it was 37 and 40. So we almost getting challenged on a call side here. IV rank was 244. I have rolled this, bringing the put strike up from 37 to 39, and also bringing the call strike up from 40 to 43. You do this kind of roll, changing the strikes, both strikes, because I was kind of bullish with the stock after this run. I think it's gonna continue to go up. You do that. You used to roll on the same strikes. I was on the 40. I was short the 40 call here. Now I'm short the 43 call. That's I'm rolling out in time, right? This is a rolling out in time. You do this. You change the strikes when you roll out in time.
Sometimes, yeah, sometimes. So basically what you've done here is you're rolling out in time and you're recentering the strikes so that you have a little bit more room on both sides. And you can certainly do that because one of the nice things about rolling out in time is you add more extrinsic value to the trade. And so, you can use that extra extrinsic value to reposition the strikes if you want to. So if you want to give yourself a bit more room on both sides, you can use that extra credit that you collect from the added time to move that call up from 40 to 43. And I can see you still collected a net credit for doing this. And that's really nice, by adding the time and the additional extrinsic value. No, it's a great adjustment move.
Yeah. Because that's something I always think about. keep the same strikes? Should I change the strikes? I think it depends on how you're feeling, right? If you, I don't know, maybe your thoughts have changed. You're not bearish with the stock anymore. I think that depends, right?
Yeah, exactly. I think, I usually like to keep my strikes the same and just kind of play into the marketplace cyclicality that just naturally happens, where things that go up tend to come back down and things that go down tend to go back up. But there's a strong case to be made for using the extrinsic value like you've done here to reposition. And so I don't really know if there's a, better or worse, adjustment here. I just think it depends on, how you are feeling about the stock and what you generally do. I mean, I would encourage everybody out there to try both ways. I mean, you could try leaving the strikes the same and seeing if, and then you're a bit more directional, you need to come back, or you can reposition the strikes and you're a little bit more neutral in your delta. So, there's a, a good case to be made for both. So I would try them both out.
Yeah. There's not right or wrong answer in those cases, right?
That's right.
Oh, here just to show the MSCI, since the stock was trading at to around 50, all the way from, we're talking about a huge ETF with a lot of companies, and this is kind of rare. It goes all the way from 50, almost 50, to 30, almost 36, right? So when things start to go up again, I think, well, maybe the best choice will be to move those strikes, this call strike up.
Yeah, no, absolutely. I mean, that's a huge move. That is a huge move for an index like that. I mean, it went from 60 to how low did it get on that previous chart?
On all the way from almost 50, 49. Here you 50 on May 2023.
Yeah,
for almost 50 on August 2023, all the way to 36.
Yeah, for an index, that's a massive, that's a 30% drop. And so, yeah, that's a very, very significant move. And so, if you have a strangle on in something like this, then rolling the calls down makes a lot of sense, just because you're going to, kind of chase the stock lower a little bit and, bring in premium for doing that and continue to neutralize, that directional delta, which again, in a situation like this where the stock keeps going down, that can be really helpful.
Yeah. And I think this chart explains a little bit, why the U.S. stock market has gone up a lot, because a lot of money was withdrawn from China, from Chinese economy, and thrown to NASDAQ, to NVIDIA, to the U.S. economy, because Chinese economy has struggled in the past, I would say, 18 months.
Yeah, exactly. And so the money has to go somewhere, right? The money has to flow somewhere. And so, yes, I think you're exactly right. The U.S. stock market has been the recipient of a lot of those funds. And so when people are looking around for what to invest in, it's like, well, the NASDAQ looks a lot more appealing than this. And the S&P 500 looks a lot more appealing than this. And so I think you're 100% right.
Yeah. So let's see. Chinese economy might go back up. We see some iron prices going up, and the housing market there has struggled a lot. The companies lost like 70-80% market value. Some companies even went bankrupt, like Evergrande, huge company. So let's see if Chinese economy recovers. I think if that happens, a good idea, a good tip here will be to buy those kind of ETFs, right? MSCI is a good one, and also FXI. That's FXI is it's a Chinese large cap ETF.
Mm-hmm.
All right, let's see here. This one, check it out. If you're looking for trouble, you found it, my friend.
There you go. Yeah.
Here we have with 30. This position, it was This slide I set up yesterday was with 37 DT. So now today is with 36 DT. Nasdaq, we have an inverted triangle here. The call is at the 4404 strike. The puts the 444 strike, and stocks trading at 440. The thing is, since we opened the trade, all the rolling that's been going out for a while, I don't know, maybe 7 to 8 months, the total credit was 4483. Did you like to keep these until closest to expiration before rolling? You roll with 21 DPE, because I'm pretty sure you got in those situations before, right?
Yeah, of course. I know. We would adjust these at 21 DT because it's still an undefined risk strategy. And so there's not a ton of additional benefit to carrying it all the way to expiration. I mean, of course, you can drain all the extrinsic value out of the options, but you're exposed to a lot more directional risk. And so that's not really our favorite thing. We would much prefer to adjust that at 21 DT. But I can see here, the good thing is you have a $40 wide inverted triangle, but you've collected a little over 44, almost $45. And so that's good because that still leaves the potential for some profitability. Now, with you being adjusting at 21 days to go, you probably won't be profitable on this trade because that probably wouldn't happen until the final days or at least the final week. But still, this is obviously a trade that hasn't worked. This is obviously a trade that's, been a sizable loser for some time. If you're able to get this off for a small or modest loss, that's a really, really big win.
Yeah, you think it will be a good idea to, I don't know, at 21 DT, just close the trade and move on? Because IV rank is not really good. And I don't know how it ranks around 22. It's not bad, but it's not something we are expecting, right? You think it's a good idea just to close this kind of trade?
Yeah, you could. You absolutely could. You get to 21 days to go. Maybe you've gotten some of your losses back and you're like, hey, I just want to be done with this trade. I want to be done with this trade. I want to move on. You could do that, or you could roll it out. You could roll it out to the next cycle. I mean, one of the benefits, and you'll get more extrinsic value for doing that. One of the benefits to trading indexes like QQQ, like, SPY, etc., is you don't have to worry about earnings. You don't have to worry about individual stock earnings. So when you have positions like this, you can carry this thing for as long as you want to. And so you're right. The IV rank is not as great. 22 is still okay. If it was like, under 10, then that would probably, motivate me more to close the trade. But I think you could go either way with this at 21. You could close it or you could roll it. Yeah.
Well, let's hope the stock at least keep between the strikes, right? Because if this goes up all the way to, I don't know, 450 or 460, then we'll have to think about what to do again.
Mm-hmm. Yeah, that's right. Yeah, that would be, 460 on the Qs. That would be brutal. Man, that would be brutal.
Well, I expect everything, man. That's something I never learned. Is people say, never bet against America. Sometimes I do bet against America, and I got in trouble for doing that.
Yeah, that's right.
Yeah, it's easier to bet against Brazil. I have to say that.
Oh, there you go. Okay, yeah, that's funny.
All right, man, we're almost done here. This is SMH is another trade here. See, that's another inverted triangle. 1872, 37 days to go, but IV rank is at 98. This will be a classic rolling, right? Roll out in time if it comes to 21 DTE and the stock was still between the strikes.
Yes, absolutely. And I mean, right here is a different situation because you've only collected 1872, but your inversion is $25 wide. And so you're looking at a loss on this trade for sure, which doesn't mean that you shouldn't hold it. You still might want to hold it and roll it and do all those things, but you just need to be aware of what you have here and what you're up against. And so, yes, trimming this loss to any degree, again, is probably going to be what you're looking to do here. But yes, with IV rank so high, this is a much, much stronger candidate to roll out and keep it on.
Yeah, that's what I thought, man. And it's always a good idea to talk with the best, man. You are the best.
Oh man, I appreciate you. I appreciate you very much.
So let's just before we go, man, let's just check some trades here in Brazil. Just not to keep talking about strangles, because I know the guys, our viewers here, don't just trade strangles. Even I'm pretty sure that is their favorite strategy. But this is actually a poor man's covered call we have here. You do this kind of trade. We bought it December 24 expiration for 198. Stock's trading at 10.65. We bought the 9.67 strike in the money. And we saw the March expiration. This is expiring now for 10 cents. You think it's a good trade? It's something you like to do? You think that's the right way to do this kind of trade?
Yeah, no, it can be. I mean, if you have a stock that you want to be long and you want to be long for a while, like you want to hold this trade for, a number of months or whatever, yeah, you can buy, a call that's several months away. Like here, the December 24, I mean, that's 9 months away. And then the great thing about a poor man's covered call is you have so many opportunities to keep selling premium against it. Like right here, you've got the March that, is about to expire. It's going to expire tomorrow, actually. And then you're going to be able to continue to sell April and May and June and July. I mean, to me, this type of strategy, it's a version of a covered call, right? It's the same type of thing, except now you're just using options. The reason why I love this type of strategy, and the reason why I love covered calls more than just holding stock most of the time, is because you bring in a whole new way to make money from the short premium and the short calls that you sell, right? When you just hold stock, which is fine because the market goes up over time, I have no problem with that. But I just think there's a better way to do it. It's like, man, let's bring in some short calls. Let's bring in some premium. Let's bring in a way to make some money when my stock might not be moving at all. And you have a similar type of idea here with this poor man's covered call. No, I love it. I love it. It's a very conservative strategy. It's a slower moving strategy, but it can make a lot of sense for a lot of people.
Yeah. So sometimes you just want to go long with the stock. You want to enjoy if the stock goes up. You want to be long, and maybe in this strategy you're just using 20%. You're just 20% of the buying power you would use to buy the stock. So I think that's a big advantage of this strategy, right?
That's right. The buying power differential when it comes to poor man's covered calls versus covered calls is very significant. So that's what makes this such an attractive strategy. Yeah.
All right. So this one, that's the last one, my friend. This is Petrobras. It's the largest company here in Brazil. It's an oil company. It has been paying a lot of dividends lately. But the thing about this company is the government runs the company. He owns over 50% of the stock. So you can imagine what happens, man, when the president says something, we're not going to pay dividends, we're going to keep the money. So it's very, what happens is a lot of times when the government, when the politicians say something, the stock just goes up a lot or down a lot. So this is the president said something, we're not going to pay dividends, we're going to keep the money, not going to pay the stockholders, they're just, I don't know, they just want money, you're going to give the money to the poor, something like that, right? And the IV rank went all the way up to 88. And we put up a straddle with 40T for 160, getting 160 with 40T. When IV rank is really high, you use straddles, I don't know, maybe to close at 15, 20% max profit.
Yeah, exactly. That's the thing. Straddles are great strategies, like what you have here with Petro. It's a great strategy, but you just have to be aware that with, that shared strike between the short call and the short put, man, it is going to cling on to extrinsic value for a very, very long time. So you need to be a far more aggressive with your management and with your profit targets. So rather than going for like 50% of max profit or 60% of max profit or something like that, that's going to take you a very, very long time to get to, and you're going to be holding risk the whole way that you get there. It's way better to, trim down that profit target. Maybe only go for 25%, maybe be okay with 20%, and just say, all right, if I get a decent amount of extrinsic value out of this strategy, 25%, I'm going to take it and I'm going to move on. And so, yes, you got to be, so, I mean, you sold this for $1.60. I mean, you get 40 cents out of this trade, Davey, I would absolutely take it off.
Yeah, that's what we did actually, because we did with 40T, so it was on Monday, have closed it on Tuesday for 128, paying 128.
There you go.
Yeah, paying 128. This is the thing. We left the door, the order open to close at 128, and so some people have closed it for under $1, $1 in this case, right? Under one, because when you left the order open, the market opens. It helps you when it opens. Your order gets filled pretty soon.
Mm-hmm. No, that's right. No, GTC orders are great. No, GTC orders, you just put them in, and if it gets hit, then it gets hit. No, that's a great way to trade, especially if you can't be trading all day. Like maybe you have, a job, you have family life, you have other things going on. I mean, I think it makes a lot of sense. A lot of sense.
Yeah. So, my friend, I know you have a very busy schedule. What you wanna show some trades, or you wanna do it again some other time?
No, let's do that another time. Maybe another time we'll get into the platform, and whether it's your platform or my platform, and we'll work through some other trades, and we'll get into Tasty Trade and do some different things. And no, that'd be a lot of fun. I think we covered a lot of ground here today, though, and so no, that was really, really good.
And for those of you who want to see some classes, our course is open. Tap our course on options here in Brazil. Mr. Jim Schultz here is one of the teachers. And if you want to trade in US, Mr. Jim Schultz is our teacher for the US trading course. Fantastic lessons on management, on how to set up strategies, how to use volatility, how to manage your trades. So the registrations are open. You just make sure to click on the link here on the description of this video. And Jim, it's been always a pleasure talking to you, man. Thanks again for the great lessons.
Of course. No, it's my pleasure. It's always fun to connect with you, Davey. And, if anybody has any questions for me, they can easily find me on Twitter, on YouTube and all those things. You can drop links into the description. And, I'm happy to help however I can.
Yeah, make sure to follow Jim on social media. He's producing a lot of good content. And you can find him also on Tastylive. All right? Thanks a lot, man. Thanks a lot, my friends. See you soon, Jim. Bye-bye.
All right. Bye.